Hello friends, welcome to my weekly market outlook video. Now in this video, I want to discuss whether the rising oil prices are having a negative impact on sentiments and whether bulls are getting concerned with oil. Now that segment is something I will cover in the last chapter of this video. This video is divided into chapters. Please take a look at each chapter. I'll discuss this in the chapter on my trading strategy, which comes at the fag end of this video. So please stay with me till then. Right now, what I'm discussing is the usual aspects of our weekly video, and coming up on your screen right now is the weekly market roundup, which tells you that it was the banking segment that rose more than the broader markets, as the Bank Nifty outperformed the Nifty 50 on a relative comparative basis. The US dollar index fell marginally. Now, gold and silver witnessed some amount of profit taking because there's been a stupendous rise in the last couple of weeks. So this kind of profit taking was anticipated. Oil and gas went up because of man-made shortages and supply constraints announced by OPEC Plus as a community. Natural gas prices are up due to the extremely routine cost of carry that one sees at this time of the year. Now, the USD INR, which is the United States dollar versus the rupee, eased marginally, which means the rupee strengthened against the dollar, and that helped sentiments in India. The NSE gained over 2.5% in market capitalization. That tells you that the rally was fairly broad-based. MWPL fell routinely by 8.5%, which is a routine matter after every expiry. And the US indices went up, led by the tech-heavy NASDAQ. So there is a possibility of some amount of relief rally in Indian technology stocks as well. Take a look at the relative performance of the Nifty versus the Bank Nifty. Now, you will see that the Bank Nifty is outperforming the Nifty's relative returns over a 4 and 12 week time frame. The 20-week time frame, of course, the Nifty is still on top. But banking and financial sector stocks command a 33.53% weightage in the Nifty itself. And I have kept on telling you that nothing happens in financial markets without a reason, and the reason itself is financial. Without pushing banking and financial sector stocks higher, you cannot have a broad-based rally. And there you have it. Banking is now playing catch-up. I come to our in-house exclusive indicators. I start with market-wide position limits. Now, these are limits utilized by traders as a total percentage of limits allowed by SEBI. What we are seeing is a routine fall post-expiry in market-wide position limits to 31.17%, which is the highest post-expiry in the 20-week time frame that we have recorded on this chart, which means bulls have basically preferred to roll over a larger component of their positions to the May series. And that tells you that there is optimism in the undertone. But this also leaves room for volatility, because a higher buildup would mean that there would be a higher amount of unwinding should something unexpected be announced. Now I come to the stock and index futures turnover of 3 cumulative series. So it is May, June and July. What you are seeing is index futures turnover has gone to its highest in the 20-week chart period that we are covering here. Part of the reason, of course, is expiry, because traders tend to roll over their positions by squaring up April series and reinitiating that exposure in May. So that results in double turnover. The fact remains that there has been increased interest in the markets, which is why you're seeing this turnover go up. I don't expect these lofty levels of futures turnover to sustain, and some amount of decline in turnover might be seen in the coming week. Now for the NSE advanced decline ratio. What we are seeing is the Nifty logged smaller gains last week of 1.23% compared to 1.79% in the prior week. But the advanced decline ratio improved from 0.86 to 1.34, which means for every 100 falling stocks, there were 134 rising stocks. Remember, this is the weekly average of all 5 trading sessions. So it's a smoothened figure, but the fact remains that buyers outnumbered the sellers and buying conviction was improved last week. Now, friends, I come to the basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot. Higher the basis, higher the risk appetite, and higher the premium that traders are willing to pay to trade that particular future. Of course, basis tends to shrink as expiry approaches, exactly like options premium. Now, what you're seeing is the Nifty and Bank Nifty basis has jumped. The Bank Nifty basis is nowhere close to the compared post expiry basis paid in the markets when March expired and April derivative series started. So traders seem to be a little more guarded in the Bank Nifty, but in the Nifty 50, the basis is comparable with the prior post expiry basis. Now I come to our exclusive in-house indicator, the impetus. You won't get this anywhere on the internet. It's exclusively our own statistical trading model study. Now both the indices have risen last week, but the impetus was lower. That means buying momentum was somewhat milder, somewhat weaker. Ideally speaking, for a sustained rally, you should have prices and impetus readings both go up together, but that unfortunately did not happen. So I would watch this number every day. Now, all these data points that I discussed so far are available every evening, late night, or maybe a few hours before the trading session starts for the day on my social media accounts, particularly my free Telegram channel. My contact coordinates come at the fag end of this video. Do take the time and effort out to connect with me there. Now, friends, I come to the lift, weight, thrust, drag index, which you've trusted for over 3 years now, and it stood the test of time. Now, what you're seeing is that the Nifty might have logged smaller gains, but the LWTD has gone from negative zone in minus 0.54 to plus 0.64. What it tells you is that lower levels will continue to meet buying support, barring unforeseen circumstances, of course. Do remember there's a lot happening geopolitically in the markets as well as politically within the country as well. So, barring any negative surprises, I think lower levels are likely to encounter buying support in the coming week. Now, friends, the in-house weekly indicators done, I come to the bond markets, which I have been leading by covering ahead of equities for a long period of time. What we saw last week was bond yields come within a kissing distance of the calendar year 2024 highs. If it was to cross 7.24%, the Indian benchmark bond yield would cross the highest point achieved in 2024. What it means is that bond prices will go down. What it also means is that the banks, which are the largest investors in bonds, will have a bigger mark-to-market notional loss on their bonds portfolio. And that means somewhat of a pressure on the Bank Nifty. Now, the yield and the impact of the yield is something I cover in the post-market summation every day on my social media accounts. Please do connect with me there. Now, this also tells you that we are so glad that we exited those 4 gilt funds when we did, getting approximately 10% pro rata returns. Although we were invested only for 12 short weeks, but we managed to clock pro rata returns of 10%, that too with 100% sovereign guarantee of the central government. Now, while we were sleeping, the President of India was guarding our funds, and we clocked 10% on that, pre-tax, of course. Now, what do we do with the fixed income market? I'm waiting for 7.65%. That's a long shot. We are currently not even at 7.25. So I'm waiting for 7.65 or higher before I start laddering bonds, which I have been telling you to do since late 2021. If that doesn't happen, I will wait for 7.05 to be violated before I go out there and get back in some good gilt funds. Maybe the same ones we exited from, maybe some other, because I will wait for our in-house trading models to basically tell us where to deploy our money. But at this point in time, I'm keeping the powder dry. So friends, the bond market's done. I now come to the Bank Nifty, and on your screen you're seeing the daily chart, which tells you that the Bank Nifty gained 1.32%. It rose on 2 out of 5 trading sessions. Thursday's gains being a prominent reason why the Bank Nifty ended the week with gains. Friday saw a reversal of sorts and a weak piercing candle. The price remains above the month-long moving average, which means the short-term outlook is positive for now. Coming to the weekly chart on your screen, what you are seeing is a long leg doji. Now that's the real body of the candle being extremely small because the open and the close is very close to each other. There is a long and prominent wick on both sides, above and below the body. That makes it a long leg doji. It invariably indicates indecision in a large segment of traders in the markets. However, the price is above its medium-term moving average. That tells you that the medium-term outlook is positive for now because the buy and hold investor is still in the money. Even though the prices have come off their highs, they are still in the money, and there's no compulsive, coercive reason to short or even sell. Friends, in the week before last, the Bank Nifty was number 4 on a most volatile counters list as per statistical beta rankings we maintain in-house. It slipped 2 notches to number 6, which means relative volatility went down. Always a positive sign for a retail trader. Less the volatility, the more he can handle risk. Friends, although I didn't record a video last week, I did share the link to my weekly live mint column, wherein I had recommended a range, estimated range, between 48,950 on the upside and 46,200 on the downside, which held perfectly well. In the coming week, I estimate a range between 49,575 on the upside and 46,850 on the downside. In addition to these ranges, do also note the daily, weekly and monthly pivots that I share on our free Telegram channel. The hyperlink to our channel comes at the fag end of this video. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 1.23%. And as you can see on the daily chart on your screen, it rose only on 1 out of 5 trading sessions. That was Thursday. And like the Bank Nifty itself, on Friday, we saw a reversal of sorts. The price is above its month-long moving average, so the short-term outlook is positive for now. The price also remains above the Fibonacci 281.68%, which is poised at 22,200, which is something I've been telling you since a few months now. So as long as 22,200 level is defended by the bulls, they still have a chance of triggering more upsides in the market. And as for whether oil will have an impact, rising oil prices rather, will have an impact on sentiments of the market, do stay with me till the end of this video. Let's come to the weekly chart on your screen, and what you are seeing is a small bodied bullish candle, which means having an upper shadow or an upper wick tells you that there was selling at higher levels. You saw that on Friday itself. The price is above the medium-term moving average, which means the medium-term outlook is positive for now. The buy and hold investor feels no reason to sell in a hurry. The all-time high remains in the vicinity at 22,775 level. And only a crossover and sustained closing about 22,775 will a fresh bull phase or a fresh leg of the rally start. Friends, in the week before last, this index was number 8 on our most volatile counters list as per statistical beta rankings we maintain in-house. It slipped sharply to number 17, which means the volatility, relative volatility rather, came down. Now, in my live mint column last week, I advocated an estimated range between 22,650 and 21,650 on the upside and downside respectively. Note, please, how the high was 22,626, which is a bare 24 points lower than the resistance level I advocated last week. This is all thanks to the in-house trading model IBEX that we use to estimate these points. Now, in the coming week, I estimate a range between 22,925 on the upside and 21,925 on the downside. Also, please watch our daily, weekly, and monthly pivots. They are available on our free Telegram channel. Do make it a point to join me there. Friends, I now come to the retail risk appetite, which tells me, and as the weekly chart on your screen tells you, that the index futures turnover contribution fell by 3 basis points. It's indicated as a blue line. The stock futures turnover contribution went up by 36 basis points, which is indicated as a red line. So risk appetite denoted by the higher capital intensive, higher volatile futures segment in the market was higher. In the options segment, what we saw was the index options turnover went up by 14 basis points. That is indicated as a green line. Now, between the two, index and stock options, index options are less volatile and they command a smaller amount of capital involvement. Stock options, on the other hand, saw a 47 basis point decline in turnover contribution, and that tells you that even though the risk appetite was okay in the futures segment, in the options segment, things were a little tepid. Part of the reason also is, of course, of expiry. In expiry, people roll over their futures positions more proactively than options, which is why the futures turnover appears to be higher. The real price discovery and turnover contribution based risk appetite will show up in the coming week. Friends, I now come to discuss my trading strategy, and I promised you I would discuss whether oil prices are likely to make bulls nervous. The short and sweet answer is yes. Why? Because oil is a multiplier commodity. You take oil prices higher, everything from milk, fruits, vegetables, your taxi fare, your public transport charges, etc. start to go up. Therefore, higher oil prices are inflationary. Do note, at the same time, the rupee is appearing weak. It's sliding slowly but surely against the dollar because the US dollar index is rising. That means it's a double whammy. Number one, oil prices are up. Number two, the landed cost of oil will be higher because our currency is also weak. Now, we are at almost 7,000 rupees a barrel of crude oil on the multi-commodity exchange in rupee terms. There is a possibility of 3 to 5% increase in the short run, which tells you that the threat of a higher inflation might just become a little more prominent in the coming week or weeks, which is why oil prices need to be watched with an electronic microscope. Do keep an eye on oil prices. Plus, it'll have a different kind of an impact on different kind of industries. On fertilizers, on paints, on oil marketing companies, it'll have a sobering effect of sales at higher levels, whereas oil canalizing agencies like ONGC, which get a commission per barrel of oil imported, will see their revenues go up, and therefore there might be a positive correlation. Of course, market volatility, thanks to geopolitics and politics, will mean that this equation will be very loose and very flimsy at best. Friends, now my own trading strategy for the week ahead. I will continue to focus on oil marketing companies and the PSU space because that's where the trader attention is. I will also continue to focus on energy counters because rising oil and natural gas prices would mean an impact on these counters. And power stocks are commanding your attention. Metal prices on commodity exchanges are in deep heat, and therefore they could lead metal companies' stock prices higher if follow-up buying comes in. If you ask me, metal prices on the commodity markets have super extended. There is a possibility of some profit taking, whether it will come this week or the next, I don't really know, but higher volatility is almost certain. Bullion will get supported on declines because there is a good deal of defensive buying coming in from strong hands, institutional hands, pension funds, etc. So I don't think bullion has reversed its trend just yet. Yes, there will be consolidation because if the dollar starts to strengthen, there might be some profit sales. But note how declines are not really panic struck at this point in time. I will continue to seek theta decay opportunities in energy commodities and, of course, at deeply out of money strikes. Friends, if at all there are any more ideas that I can think of, I'll be very happy to share with my online family on our free Telegram channel. Do connect with me there. Friends, before I bid goodbye to you in this video, a reminder to subscribe to our YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comment segment, please let me know how my videos are helping you improve your trading and in your journey as a trader. Also a request, please share my video with smart traders like yourselves on your social media groups with your friends and family to help me reach out to a wider audience. I thank you for your patience in being with me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Have a very profitable week ahead. Thank you. Bye-bye.